Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, my name is Fitri Kurniasih. I'm from Marcibuana University, and in this video, I will answer several questions for my final exam in English for accounting. There are 5 questions. Number 1 is about direct and indirect costs. Number 2 is about case of direct and indirect costs. Number 3 is about stock market and analysis stock market. Number 4 and 5 is about rules accountant in globalization era. Number 1, the difference of direct and indirect costs. There are 4 bases of difference between direct costs and indirect costs. Number 1 is part of output. Direct costs become the part of output, meanwhile indirect costs do not form a part of output. Number 2 is identification. Direct costs can be allocated to the product or service, meanwhile indirect costs cannot be allocated to product or service. Number 3, part of prime cost. Direct costs are part of prime cost, meanwhile indirect costs are the part of overhead. And the last one is controllable. Direct costs are normally controllable costs, but indirect costs are not uncontrollable costs. Distinguishing between direct costs and indirect costs helps us to better understand the costs in our business incurs, but in actually this distinction is sometimes hard to make. For example, if you own a restaurant, you need to keep a skeleton staff in the kitchen, whether or not a single customer walks in a door and order meals. Kitchen labors is a direct cost, but paying kitchen staff when there are no customer is in indirect cost. So this is the difference of direct and indirect costs. Direct costs are business expense that can be directly applied to producing a specific cost object like good or service. Direct costs can be variable or fixed costs. Direct costs include manufacturer supplies, equipment, raw material, labor costs, and other production costs. Meanwhile, indirect costs are costs that are not directly accountable to as cost objects, such as a particular project, facility, function, or product. The indirect costs include utilities, office supplies, office technology, marketing campaigns, employee benefit, accounting and payroll staff, and then insurance costs. Number 2 is about case indirect costs and indirect costs. Let us consider a factory named XYZ company that has the following information, and from the below furnished information, the total indirect cost of production has been calculated. They have raw material cost $300,000, labor wage $150,000, depreciation $5,000, repairs and maintenance $50,000, office electricity expense $10,000, salaries $100,000, factory supplies $3,000, accounting expense $10,000, auditing expense $5,000, and legal expense $3,000. So the amount of indirect costs are total indirect manufacturing overhead plus total indirect administrative overhead. The total of indirect manufacturing overhead can be calculated by depreciation plus repair and maintenance, office electricity plus salary, and plus factory supplies. Meanwhile, the total indirect administrative overhead can be calculated by accounting expense plus audit expense plus legal expense. So the amount of indirect cost is $186,000. And the total of direct cost can be calculated by raw material cost plus labor wage for $150,000. The number 3 is about stock market. Stock market refers to a public market that exists for issuing, buying, and selling stock that trade on a stock exchange or over to the counter. Stock, also known as equities, represent fractional ownership in a company, and the stock market is a place where investors can buy and sell ownership of such investable assets. An efficiently functioning stock market is considered critical to economic development. Stock market analysis and investor may look at a variety of factors to indicate a stock market probable future direction. Stock market analysis and investor may look at a variety of factors in indicate a stock probable future direction up or down in price. Here is a rundown on some of most commonly viewed variables for stock analysis. So there are several ratios to analyzing stock market. Begins with price to earning or PE ratio. This is a ratio of a company's stock price in relation to its EPS. A higher PE ratio indicates that investors are willing to pay higher price per share for the company's stock because they expect the company to grow and stock price to rise. Number 2 is return on equity ratio. Return on equity ratio is considered a good indicator of a company growth potential as it shows the company's net income relative to the total equity investment in the company. Number 3 is debt to equity ratio. This is a fundamental metric of company financial stability as it shows what percent of company's operations are being funded by debt compared to what percent are being funded by equity investor. A lower debt to equity ratio indicating primary funding from investor is preferable. The last one is profit margin. There are several profit margin ratio that investor may consider, including operating profit margin and net profit. The advantage of looking at profit margin instead of just absolute dollar profit figure is that it shows that what a company percent profitability is. For example, a company may show a profit for $2 million, but if that only translates to a 3% profit margin, then any significant decline in revenues may threaten the company's profitability. The number 4 is globalization era. Globalization is a concept that refers both to the compression of the world and the intensification of consciousness of the world as whole. While globalization has everything to do with accountants, globalization has increased the job mobility of accountants worldwide. Before employing an accountant, employer and client need to know that accountants that they wish to employ are competent and preferable of international standard. As the provider of one of the most needed services in financial sector, accountants will certainly feel the full impact of economic globalization. The whole field of accounting is feeling the wind of change brought about by globalization, where only those who adapt to it will thrive. The rules of accounting in globalization era is divided into main sections. The first part discusses the rules of accounting in the globalization era is divided into the main section. The first part discusses the definition of management accounting and its feature. The second part is discuss the globalization and its feature. The third part focused on the role of accountants, and the fourth part seek public perception toward the accountant. Management accounting has been defined in many different ways, whether by describing its roles or describing its objectives and processes. Generally, it could be remarkable that the traditional definition of management accounting describes management accounting based on the fact of providing information to the manager. So, management accountants were considered as information provider only as we notice from the following definition. Managerial accounting is concerned with providing information to manager, that is people inside an organization who direct and control its operation. So I think that's enough for my answer to the final exam. Thank you for watching. See you.